Friends, in today's video, we will discuss what mutual fund investors should do if a war breaks out between India and Pakistan. Recently, a terrorist attack took place in Pahalgam, where 26 of our tourists lost their lives. Following this tragic incident, this situation has become tense, and there is growing speculation that a war between India and Pakistan might occur. Now, the question arises, what should mutual fund investor do in such a situation? So far, despite the tragic event, we haven't seen any major reaction in the stock market. The market has been fluctuating up and down over the past few days, and we cannot directly attribute this movement to the Pahalgam incident, as such fluctuations have been seen in the markets regularly over the past few months. But what if a full-fledged war actually happens? How would the market react then? In next section of this video, we will discussing how the markets reacted in similar situation in the past, so we can also predict what market can do in the future if a war-like situation continues or actually a war happens. To understand the future, we must first learn from the past. India has unfortunately faced several terrorist attacks in the past. By analyzing how the market behaved during such times, we can make a fair assessment of what might we can expect if a war breaks out now, especially since an attack has already occurred. Let us not go too far back. We will only start from 1999, from the Kargil war. How did the market reacted back then? Initially, there was a sharp drop when it became clear that the Pakistani forces had captured key Indian posts and war was imminent. But very soon after the war began, the market recovered quickly. Just about 2 years later, in 2001, there was an attack on the Indian Parliament. Even at that time, the markets reacted negatively at first, but then recovered within a few days. The situation was similar to what we see now. There was a fear of war, but it didn't materialize, and the market stabilized after the initial panic. Moving further, in 2008, the infamous 26/11 attack was there. We witnessed the horrific Mumbai attacks. However, this time, surprisingly, instead of falling, the market rallied, and then this rally was called a patriotic rally. Further, one more terrorist attack was there in Uri on our military in 2016, which resulted in India attempting Balakot surgical strikes in POK, and market repeated the same pattern, down initially and then recovered quickly. And after the Pulwama attack in 2019, we again saw a brief dip in the market, followed by a quick recovery. Similar to earlier events, fears of war loomed, but confidence in the strength of India's economy helped the market bounce back. It happens because people have faith in our growing economy. Whenever the market drops, even slightly, smart investors begin to buy. These investors are always on the lookout for such opportunities to invest at lower valuations instead of exiting the market in fear. So while small retail investors may panic and sell, experienced investors buy during such dips, pushing the markets back up. In the next section of the video, we will talk about what mutual fund investor should do if a war actually happens and causes a sharp fall in the market. If a war between India and Pakistan truly breaks out and there is a sudden market decline, whether big or small, the first thing you need to do is stay mentally strong. Remind yourself why you invested in mutual funds at the first phase. That is your financial goals. You invested for the long term. Mutual fund investors are not traders. People who choose mutual funds typically have a long term horizon. They invest either for wealth creation or for a specific goal that might be 3, 5 or even 10 or more years away. So remember your goal and stay invested until you achieve it. As we discussed earlier, whenever corrections happen, whether due to war or any other reason, you should remain invested. If you are investing through SIPs, do not stop them. In fact, if possible and you have some extra investable funds, try to increase your SIP amount. This is a golden opportunity to step up your investments. The same logic applies to lump sum investments. Investors often ask when to do lump sum investments. The answer is invest lump sum amounts during market corrections. Opportunities arise when the markets become volatile, especially in categories like small cap, which tend to react sharply even to minor negative news. This makes their NAV fall, offering you a great entry point. Aggressive funds such as small cap and mid cap funds or funds following aggressive investment strategies are best suited for such opportunities. The right approach is to invest during dips, not to exit in panic. However, when doing lump sum investments, keep this in mind. Never invest the entire amount at once. Instead, divide your investable amount into installments depending on your risk tolerance, maybe in 3, 6 or 10 parts, and use the STP, that is systematic transfer plan route, to stagger your investment in a chosen fund. If you have been investing in mutual funds for some time, you already know that markets always recover over time, and long-term investors often get excellent returns from mutual fund investments. It is also true that the more you invest during corrections, the better your returns tend to be over long term. That is why SIP works so well. You keep investing regardless of whether the market is up or down. You get units at different price points, and over time, this cost averaging results in great returns. If you invest smartly and wait for meaningful corrections, say up to 5% or 10% or even more, before deploying your lump sum amount, and if you have investable funds available at those times, you can achieve outstanding returns from mutual funds. This video is for educational purposes only and not an investment advice or recommendation.